Love it or hate it, the CPP has seen major changes since 2019, including the recent CPP2 enhancement. While some call it a scam or a ripoff, others see it as a crucial necessity. So why are there these two opposing and polarizing views? Let's break down the exact changes of the CPP enhancements, why the government put it in place, then I'll address the criticisms at the end to see if the skeptics have a point. The CPP now includes two levels of contributions, with updated thresholds and rates that enhance retirement benefits. Here are the key points of this table. So for regular CPP, contributions are calculated on earnings up to the YMPE. In 2025, it is $71,300. Employers match employee contributions and self-employed individuals pay the combined rate. Now for CPP2, it applies to your earnings between what's called the YMPE and the YAMPE, which is capped now at $81,200 in 2025. If you earn more than that, you won't pay any more in CPP. Let me show you how this works with an example. Meet Mark, who earns $71,300 in 2025. His contributions are as follows. To calculate his pensionable earnings, you must first take the YMPE of $71,300 of which he is earning, minus a $3,500 exemption. That means it will be $67,800 is what his is calculated from. And at a 5.95% contribution rate, he'll be contributing $4,033 approximately. And this will be matched by his employer. So he'll be in total contributing over $8,000. For the second example, meet James, who earns $81,200 in 2025. His contributions will now include both regular CPP and now CPP2. So to calculate James's contributions, his first tier will be the same as Mark. So he'll be contributing $4,033 for his first $71,000 approximately. And now between the YMPE and YAMPE of $9,900, he'll contribute another 4%. So that's another $396 he'll be contributing. So his total contribution will be $4,429, and that will be matched by his employer. So it'll be close to $9,000 in total. Now let's take a look at different income levels and we'll see how this CPP2 affects it. So as you can see here, there's max CPP contributions. At $81,200, both regular CPP and CPP2 contributions reach their respective caps, totaling $40,430. And CPP2 contribution thresholds apply only to earnings between $71,300 and $81,200. There is no further contributions beyond the YAMPE. For incomes above $81,200, total contributions remain the same at $4,430, as you can see here in the table. You can think of CPP2 contributions like an add-on to a streaming subscription. It's an added cost, but you get extra benefits for your future. It's now designed to replace a third of income. The end goal of these changes are to replace more of your income. And here's how that works. The key components of the CPP enhancements is number one, it's an increased income replacement rate. So the previous rate, the CPP replaced 25% of a worker's average lifetime earnings. Now with the enhanced rate, the replacement rate is set to rise to 33.33% of average work earnings, or a third. And this will be phased in over 40 years starting in 2019. Some examples of the CPP enhancements are you'll now eventually receive significantly more in CPP when you retire. So in theory, once it's rolled out completely, someone earning $60,000 will previously have received about $15,000 in CPP benefits per year. And now with the enhancements, they'll receive about $20,000. So that's an extra $5,000, which is a pretty big amount for someone earning $60,000 on average. I want to explain more about the gradual implementation over 40 years. The enhancements are being phased in gradually, which started back in 2019. So those retiring sooner won't be seeing as big of an increase as someone retiring later. Here's how that works. For individuals retiring in, say, 2026, having contributed under the enhanced system for just 7 years, these individuals will see a modest increase in their CPP benefits. For instance, someone earning $60,000 average annually might see an income replacement rate closer to about 26 or maybe 27%. So they're looking at $15,600 to about $16,200 per year. And for individuals retiring in 2059, these people, assuming that they have contributed under the enhanced system system for the full 40 years will benefit from the maximum 33.33% replacement rate. So for the same $60,000 in annual earning, this equates to $20,000 per year. If you want to learn more about what the actual average CPP Canadians receive per month, check out my popular video on the channel. So why are they enhancing CPP? Why was 25% not enough? Well, let's talk about the 3 pillars of retirement income. Canada's retirement income system is built on 3 key pillars, and that first is government benefits, which is the CPP, and other things like the OAS and GIS. For the second pillar, you have your employer-sponsored pension plans. They could be defined benefit or defined contributions. For the third pillar, you're looking at personal savings like your RSPs and TFSAs and other assets. Together, these are meant to provide a secure and comfortable retirement. However, the retirement landscape has shifted in recent years. Traditional defined benefit pension plans, once a cornerstone of retirement security, are now quite rare. In their place are defined contribution plans that place investment risk squarely on employees, leaving many Canadians with less predictable and less reliable income in their later years. To address this growing uncertainty, the government is enhancing the CPP, strengthening the first pillar of retirement income. These enhancements aim to provide a stable, inflation-adjusted foundation of guaranteed income that retirees can rely on, no matter the market's ups and downs. While personal savings and workplace pensions still play a very important role, they are increasingly subject to volatility and individual decision-making. The enhanced CPP offers a safety net that reduces dependence on these uncertain sources, creating a more balanced and depending approach to retirement planning. The government is trying to help Canadians navigate the challenges of rising costs, longer life expectancies, and evolving financial risks. Now let's talk about the criticisms of the CPP enhancement. The CPP enhancements are meant to give Canadians more financial security in retirement, but not everyone is thrilled about the changes. Some big concerns revolve around the added costs for workers, employers, and self-employed individuals. The first criticism is the financial strain on workers and employers. Many are already complaining about the contribution increase from 4.95% to 5.95% in recent years, and now they are adding CPP2 for even more payments. For employers, the higher contribution rates mean less take-home pay, which isn't great when living costs and inflation are already squeezing budgets. Employers are also feeling the pinch. They have to match these increased contributions, which can add up quickly. For smaller businesses, this can mean tough choices about hiring or cutting back in other areas. This could also have a hidden cost of employers simply paying their employees less to make up for the difference. And worst of all, if you're self-employed, you're on the hook for both the employee and employer portions, which can make managing your cash flow that much harder. We've heard firsthand from many clients concerned about the impact of these enhancements, especially employers struggling with the added costs for their teams. In these cases, we work closely with them to create customized strategies that balance these new obligations with their broader financial goals. The second big criticism is broader economic concerns. On a bigger scale, there's worry about how these changes might affect the economy. If employees are bringing home less money, they're likely to spend less, which could slow down economic growth. For businesses, higher payroll costs might mean putting off plans to grow or invest in new opportunities, which could have a ripple effect on jobs and innovations. The third criticism is debates about the mandatory contributions. Now there's the argument about whether mandatory contributions are the best way to go. Many people feel that personal savings options like the RRSPs and TFSAs offer more flexibility and control. Unlike the CPP, these let you decide how much to save and where to invest based on your own goals and circumstances. My personal take is that I could see both sides of the argument. I understand the need to protect vulnerable Canadians, but the recent enhancements and increases do feel like a lot to me, especially as a business owner and someone who likes to control their own investments. Personally, I would love it if there was a way to individually maybe opt out of the CPP, at least partially, given that you meet like a certain set of criteria. For example, maybe if you hit a certain level of assets or net worth, but I understand that wouldn't be the easiest to track. Overall, I don't mind the CPP enhancements too much because I believe the CPP investments are pretty well managed, and I go into a deep dive into that in a previous video of mine. But money decisions always spark debate, especially broad-reaching programs like the CPP, but the key is focusing on what you can control. And that's what we do here at Blueprint, which is helping you navigate the complexities of CPP and other financial decisions to create a personalized plan that works for you. If you're ready to take control of your retirement and CPP planning, visit our website to see our services or book a consultation today. And if you found this helpful, don't forget to like and subscribe to our channel for more retirement tips.